Here's an investing experiment I want to walk you through. It starts with the smallest possible number. $1. Not $500 a month. Not a bonus check. Not a windfall. $1 per day, $365 per year, consistently invested in a diversified stock market index fund earning a historical average return of roughly 8% per year. I want to show you what that looks like depending on when you start. Because the difference in outcome is so large that most people, when they see the actual numbers, genuinely can't believe it's from the same dollar amount. This exercise isn't really about the dollar. Nobody's financial future hinges on whether they invest literally $1 a day. The dollar is a unit of analysis that reveals something fundamental about compound interest that the big numbers tend to obscure. When you use small, relatable numbers, the math stops feeling abstract and starts feeling real. My name is Eddie, and I spend way too much time thinking about money, compounding math, and the financial decisions you make in your 20s and 30s that will either haunt you or reward you decades later. If you want to see the most compelling visual demonstration of why starting early matters more than starting smart, hit subscribe and give this video a thumbs up if it changes how you think about time. If you've been telling yourself you'll start investing when you have more money, this is the video that explains what that delay is actually costing you. Hit the like button. Let's start with the baseline scenario. You begin investing $1 per day, $365 per year, at age 20. You invest in a broad market index fund. You earn 8% average annual returns. You never increase your contribution. You never touch the money. You let it compound for 45 years until age 65. At age 65, you have approximately $130,000. From $1 a day. From $365 a year. That's $16,425 of actual dollars you put in over 45 years. The remaining $113,000 or so came from compound interest, from money earning returns on previous returns. The initial investment did about 13% of the work. Compounding did 87%. Now let's move the start date. Same $1 per day. Same 8% return. Same age 65 endpoint. You start at 30 instead of 20. You've given up 10 years. At 65, starting at 30, you have approximately $59,000. You put in $12,775 of actual dollars over 35 years. You ended up with $59,000. Compare that to the $130,000 from starting at 20. You invested only $3,650 less in actual dollars over a lifetime. But you ended up with $71,000 less in total wealth. Those 10 years didn't cost you $3,650. They cost you $71,000. Let's push the comparison further. Same $1 per day. Same 8%. Start at 40. You have 25 years until 65. At 65, starting at 40, you have approximately $25,000. You invested $9,125 in actual dollars. You ended up with $25,000. So starting at 40 instead of 20, investing $7,300 less in actual dollars, cost you $105,000 in final wealth. The difference between a $20 start and a $40 start is not the $7,300 in skipped contributions. It's over $100,000 in lost compound growth. If these numbers are landing differently than you expected, hit the like button and subscribe. There's a lot more financial math that changes how you see these decisions. This demonstrates a principle that is genuinely one of the most important ideas in personal finance. The value of compound interest is not linear, it's exponential. And because it's exponential, the earliest dollars you invest are worth dramatically more than the later dollars. Not slightly more, dramatically more. There's a useful way to think about why this is true. When you invest $365 at age 20 and it earns 8% for 45 years, that $365 becomes approximately $11,500. When you invest $365 at age 40 and it earns 8% for 25 years, that same $365 becomes approximately $2,500. The same dollar amount. The same rate of return. But the 20-year-old's $365 contribution ends up being worth 4.6 times more at retirement than the 40-year-old's identical contribution. The only variable is time. Now let's flip the question. What if you started at 20 but could only manage $1 a day for 10 years, then stopped completely, never invested another dollar after age 30? How would that compare to someone who never invested a dollar until age 30 and then invested $1 a day all the way to 65? The person who invested only in their 20s, $3,650 total, then stopped completely, would have approximately $71,000 at age 65. The person who started at 30 and invested all the way to 65, contributing $12,775, would have approximately $59,000. The person who stopped investing at 30 and never invested another dollar ends up with more money at 65 than the person who invested consistently for 35 more years. The 10 years of early compounding provided more ultimate value than 35 additional years of contributions starting a decade later. This is often called the parable of the early bird investor, and it's one of the most counterintuitive results in personal finance. It works because the early contributions have so much more compounding time that they eventually outgrow the cumulative effect of many more contributions made later. Now, a crucial caveat. This analysis assumes you can only invest $1 per day, a fixed, tiny amount that doesn't change over time. In reality, most people's income grows significantly over their career. A 40-year-old who earns more than they did at 20 can offset the lost compounding time with larger contributions. If the 40-year-old investor contributes $4 per day instead of $1, a larger amount, more reflective of higher income, they end up at approximately the same $100,000 as the $1 per day investor who started at 20. The lesson isn't that it's too late if you're 40. It's that the later you start, the more you need to contribute to arrive at the same destination. Starting at 20 with $1 a day is roughly equivalent to starting at 40 with about $4 a day. Time is the cheapest form of financial leverage you will ever have access to, and it's only available once. The $1 a day is the unit of measurement, not the goal. The goal is to start now, at whatever level you can manage, with the honest understanding that every year you delay is a year of compounding time you cannot buy back. The most expensive thing about not investing today isn't the contribution you didn't make. It's the 30 years of growth that contribution will never have. If this changed the way you think about starting early versus starting big, share it with someone who's been waiting to invest until they have enough money to make it worthwhile. Subscribe if you're not already, and hit that like button on the way out. I'll see you in the next one.